Hi, this is Jason Fink at Graves Light Lenhart. This quarter, our presentation will center on the condition of the broader economy, as it forms the foundation of the financial landscape. When periods of strain or opportunity emerge, a clear understanding of economic forces is essential to interpret their nature and to determine the appropriate investment response. Despite the substantial policy fluctuations of 2025 and the general level of uncertainty in the economy, economic growth appears to be on solid footing. While first quarter GDP growth was mildly negative, second quarter real GDP growth was around 3.3% on an annualized basis, and indications are that third quarter real GDP growth is likely to continue to be solid. The Atlanta Fed GDP Now metric that we often reference for an early indication of real GDP growth indicates an estimate of 3.8% annualized growth for the quarter, which if realized would be a quite strong performance. Investment in artificial intelligence has been a notable contributor to real GDP growth, but is not the only driver. Consumer spending, for example, has also been a consistent contributor to the growing economy. Unfortunately, the broader economic landscape is a bit more nuanced, and the nuances are tricky. In a surprising pairing with strong economic growth, the labor market has shown indications of softness, with the unemployment rate drifting up to 4.3% in August, which is up from 4.2% in June, and part of a slow but steady increase over the last couple of years. In early September, the Bureau of Labor Statistics revised downward the estimated number of jobs created between March 2024 and March 2025 by 911,000. Such revisions are not unusual, but the unusual size of the revision suggests a weaker labor market than previously believed. Unfortunately, the government shutdown prevented the timely release of the September labor market report, which would have included more up-to-date statistics. However, the private sector reports continue to be consistent with the limited hiring and limited firing narrative of a cooling labor market. For as long as the government shutdown lasts, publicly produced economic data will be absent. The longer we proceed in the absence of such information, the greater the economic uncertainty there will be, with potential ramifications for efficient asset pricing. One of the biggest economic stories over the last few years was the significant rise in inflation to over 8.5% in 2022, followed by its relatively swift return to almost typical levels. Inflation reached a recent low in April of 2025, dipping to 2.31%. However, inflation has been creeping up ever since, most recently to 2.92% in August. This creates a challenge for the Federal Reserve, whose dual mandate is to both keep inflation around 2% and to keep unemployment near the natural rate. In the current environment, making progress on the first mandate would suggest raising interest rates to slow the economy, while making progress on the second would involve lowering interest rates to spur the economy along. Jerome Powell, the Federal Reserve Chair, recently stated that the increased downside risks to the labor market thus spurred September's decision to cut interest rates, and that the current level of rates is modestly restrictive, indicating room to cut further if needed. However, he also reiterated the commitment of the Federal Reserve to bringing inflation down to the 2% goal. The market currently expects the Federal Reserve to cut interest rates further, but the optimal course for the Fed is far from clear and will be driven by future economic data. Meanwhile, Federal Reserve actions, U.S. government tariffs, and other factors continue to affect the value of the U.S. dollar. Coming into 2025, the dollar was quite strong when measured against a basket of other currencies. Since the tariff issue gained steam in March, the trade-weighted value of the dollar declined appreciably and is now down about 6% from the beginning of the year. If the Federal Reserve were to continue to cut interest rates, that would be expected to put further downward pressure on the dollar. However, there are many forces that act on the dollar at any moment in time. The chart at the bottom of the slide illustrates the paths of the value of the dollar at various recent historical times when the Federal Reserve was cutting interest rates. While rate cutting should put downward pressure on the dollar, when economists say ceteris paribus, which is Latin for all else equal, they mean it. Real-world events and economic crosswinds often affect the dollar in ways that is quite difficult to predict. The equity market continues to perform impressively in the face of these economic uncertainties. The S&P 500 returned 8.1% in the quarter, with growth outpacing value. On the heels of significant outperformance last quarter, non-US developed market returns were positive, but they underperformed domestic markets. Small caps outperformed large caps. Interestingly, it was the less profitable Russell 2000 outperforming the S&P 600, which is the small cap index that contains the larger portion of profitable firms. This outperformance may be explained by the greater solidity of the economy than expected at the beginning of the quarter. Domestic bonds returned 2% on the quarter, while commodities trailed equities considerably. While stocks have outperformed, it has left them comparatively expensive. This is especially true of AI-related stocks, which comprise a large portion of the valuation-weighted stock market. The cyclically adjusted PE ratio, or CAPE, measure of the valuation level of the market began October at a value of about 39.5, which is the highest it has been since before the dot-com market crash around the turn of the century. It is notoriously difficult to determine a true asset bubble until well after the fact. However, the behavior of AI-related stocks is at least reminiscent of earlier bubbles, as we can see in the figure in the lower left. In these previous cases, a measure of euphoria and the associated shrugging off of valuation concerns eventually ended quite badly. This risk is particularly heightened because of the concentration of these AI stocks in market indices. The tech sector now comprises over 35% of the U.S. market. We continue to monitor risks associated with potential froth in the market and remain committed to our value-related approach to investing. Investor embrace of riskier assets can be witnessed throughout the markets. Over the past year, as we see in the figure on the left, tech firms that do not turn a profit have provided a much higher return than profitable companies over the past couple of months. Similarly, as seen earlier, the Russell 2000, which contains a disproportionate share of unprofitable small-cap stocks, has recently outperformed the profitability-screened S&P 600 to a significant degree. This kind of outperformance has historically been seen primarily on occasions of significant risk-taking on the part of investors. Further heightening economic uncertainty and risks in financial markets is the current shutdown of the federal government. However, it is appropriate to note that federal government shutdowns have not generally been associated with negative asset market outcomes in the past. We see on the screen that when we consider government shutdowns of more than a day, stock markets tend to be up within 3 months to a year of the start of the shutdown. However, this is not universally the case. Further, the unusual confluence of geopolitical risk, economic uncertainty, and high valuation in the markets at present lead us to remain on guard for signs that the governmental turmoil may have asset market implications. The shape of the U.S. Treasury yield curve, which tells us the return an investor will get for investing in U.S. Treasury bonds for different maturities, is also reflective of the unusual economic environment. Currently, short-term Treasuries yield more than 2 or 3 year bonds, supported by the Federal Reserve keeping the federal funds rate in the 4 to 4.25% range. The federal funds rate is the overnight rate for bank deposits, and so a shorter horizon than any seen on this figure. Our best description of this figure is ladle-shaped, and I can assure you there is no common shorthand for this in economic theory. This shape and our appraisal of the condition of the economy has informed our bond holdings, which favor investment-grade bonds and relatively shorter duration. Investment-grade bonds earn a little more than the less risky Treasury bonds, and the shorter duration allows us to capture the elevated returns on the shorter end of the curve without the risk associated with the longer time to maturity. With spreads of Treasuries and the shape of the yield curve constantly changing, this is an area of the investment universe that we are constantly monitoring. Meanwhile, the spreads of high-yield bonds over Treasuries are very tight, and this tightness exists globally, not just in the United States. There are a few ways to interpret these tight spreads, but unambiguously, they imply limited compensation for taking on default risk relative to historical standards. While this is likely reflective of a stronger economic environment than expected 6 months ago, it also fundamentally changes the risk-reward trade-off of these securities, reducing their appeal. Further, when high-yield spreads widen, they tend to do so rapidly, resulting in potentially significant losses. We are currently recommending clients avoid this part of the market specifically because of this risk-return calculus. The reward does not, in our estimation, seem proportional to the risk. By contrast, investment in a broad class of high-quality bonds appears to have a more favorable risk-reward trade-off. The yields on such bonds, represented in this figure by the Bloomberg U.S. Aggregate Bond Index, was around 4.37% at the end of September. The safety of these bonds, coupled with their low correlation with stocks, makes them a natural fit for the ballast portion of a portfolio. As can be seen on the right, the current structure of yields is such that a 1% parallel shift up in the yield curve results in an estimated negative 1.7% return to the aggregate bond portfolio, indicating a relatively limited downside risk in an adverse environment. Meanwhile, a 1% parallel shift down in the yield curve would result in an estimated 10.4% positive return, providing an attractive risk-return trade-off. From COVID and the associated policy actions to the supply chain disruptions post-COVID, the rise of AI-oriented stocks, a substantial inflation surge, unprecedented tariffs, and war in Europe and Israel, the U.S. and world markets have seen significant upheaval over the last several years. 'Twas ever thus. As events shape the economic world, assets change value to reflect the new information. Over the course of the past half-decade, for example, the value of growth stocks have increased more than the value of bonds. A key task of financial management is the rebalancing of a portfolio to keep these asset price movements from distorting the totality of the holdings. For example, consider the illustrated hypothetical portfolio that begins in 2019 with 60% of the investment holding stocks and 40% invested in bonds. The stock holdings break down initially such that 10% of the portfolio is invested internationally, 25% is invested in domestic growth stocks, and 25% is invested in domestic value stocks. Since stocks have outperformed bonds and growth stocks have outperformed everything else, notice how this portfolio would have shifted if left unattended over the last 6 years. The increase in growth stocks value would mean that they alone comprise 38% of the portfolio, and that stocks in total would be about 75% of the portfolio. The final portfolio has drifted into becoming substantially riskier than where it began. Portfolio rebalancing involves the sale of assets that have increased in value, and then using the resulting proceeds to purchase assets that have not fared as well. This provides discipline to the portfolio that is counter to human nature. It is simply counterintuitive for people to sell assets that are doing well and buy the ones that haven't done as well. However, this process of selling high and buying low keeps risk in check, and research shows that it tends to increase returns through time relative to simply buying and holding the assets. With the recent run-up in growth stocks, portfolio rebalancing has taken on particular urgency for the maintenance of well-structured portfolios. Thank you for your time and interest. We hope you found this information useful. As always, please let us know if you wish to discuss these or any other issues. We're here to help.